What's up guys, welcome to my YouTube channel. Today I'll be sharing my thought process on how I frame my directional bias. So first thing is first, you want to have a defined range. How you define a range? You want to see the market taking out both sides of the market's liquidity. So here say sell side taken out, so you want to see buy side being taken out too. So now you have a defined range from the low to the top. Now the next thing, you have to frame your 50%, your equilibrium, so that you can know that you are in premium or discount, right? So from the low to the top, that's your 50%. Below is discount, above is premium. So now below you want to sell, below you want to buy, above you want to sell, right? So you have liquidity taken out, you can sell to discount into internal range liquidity, which is your fair value gaps and your short-term lows inside of this range. That's your internal range liquidity, that's external. So if price would return inside, all this entire range is premium, so every setup going down, you're welcome to sell, but it would be riskier to try to buy inside of this range. If you are below price, it's riskier to sell when we are in discount. You want to buy inside of this range, but you can't just buy because you are below price. You have to use your PDRAs, right? Your order blocks, your fair value gaps, and price. We don't trade levels, we trade the reaction of levels, right? So if price reacted on the 50, you're welcome to buy price to take it up. But if it doesn't react, you don't just buy, you wait until to see how far can it reprice to. So now let's look at the actual price. First, you want to define our range. How we do that? We look at the liquidity run on both sides of the market. So for buy side, you have this level right here. Let's make this line straight. Then for sell side, you have this low right there, this one. Why not this one? Because this took out the previous liquidity, so now liquidity is resting on the next candle. So now we have to frame our 50% so that we can have a defined premium and discount price. So that's our range from there to there. You could use this candle because this candle took out the previous candles, but for the sake of accuracy, we're gonna use the entire range, right? So now the next thing is we have to define our PDRAs. The first thing that comes to my site, you can see we have a fair value gap, right? So you have to ask yourself, what's gonna prevent price from going up? We have two things. We have the fair value gap, we have the bearish order block, and the 50% line. So now if you would buy price, you wouldn't want to buy past these levels, or if you are in a buy position, you wouldn't want to hold price past these levels. And also note that we are already inside of this fair value gap, so price is more likely to reverse in here and trade down. But like I said, we trade the reaction of levels, not the levels. So we have the low here of the fair value gap, which is also we have this low, which is also an order block. Why? Because of this candle. This candle closed above this candle, so which makes this an order block. If we only purged and revert, we could say, okay, this is just a fair value gap, we're going down, but it hasn't reacted yet, so it can still push higher into premium. right? So you want to ask yourself, where is price trying to reach for? So we're trying to reach for this order block, or the 50% equilibrium premium price, or you're trying to fill this entire fair value gap imbalance, right? Those are questions you should ask yourself. So if I want to buy, how is price going to go up? You have to think of power of 3. You want to have a sell to buy, right? If I'm going to trade down, I would want to see price trade above this candle to sell, right? Take out this liquidity and sell. But so far you don't know. You want to see a reaction. So now, what do we have above? We have this order block. Can use the body because it's close to the 50%. So that's our daily order block, above and below. So now, like I said, price moves from external, which is this external range liquidity, to internal. So this is inside, that's outside, that's outside. So now, if you can look at price, you have a range defined from here to here, right? We have external range, price traded inside into this internal range, traded back outside, external range, back inside, internal range. Now this switches. This candle becomes external based on the new range. Now we're trading back inside of this fair value gap, which is internal because it's inside this range from here to here. We are inside, external. Now we are outside, internal, this imbalance plus the volume imbalance, internal, external, internal again. So that's how price moves from internal to external range. So now we can see that we're from here to there, we are now inside of the internal range liquidity. So if we would reprice lower, we would seek external range, but we don't know how far inside of this entire range we want to reach for. That's why we have PDR raise, this number 2. So now let's see how price pushes. So if I would buy, I would want to see a protection lower to push higher, right? If I would want to sell, I would want to see a price push high to sell. That's it. So now let's see how the daily candle prints every day. Okay, we have price trading inside of this order block. An order block is just a change of state of delivery. So you don't have to worry about did this order block take out a high or what. No, don't do that. So this candle took out liquidity, this liquidity. That's what makes this candle valid. So if price was to trade past all of these candles will be an order block because we are delivering down to deliver up. So if price would trade outside of the entire range, all of these candles is an order block, not the last candle. So currently we only traded past this candle, which also took out liquidity. So now we have closed above. We didn't just purge and revert to trade down. We closed above. So this candle right here made this order block valid. So now price is reacting from the order block. If it trades down, it's fine. We don't want to tell price what to do. We just see how it reacts, right? So now we see that there's a reaction on this in this order block. So it's an institutional price or whatever. So price is sensitive on this price point. So obviously on your lower time frame, this might happen during London. On the next video, I'll show you on the lower time frame how we would have entered using the ICT 2022 mentorship. So now, when this happens, you want to ask yourself, okay, we have a reaction from this order block. Where is price trying to reach for? We have this order block low, we have the body, we have the 50%, which is premium. After that, I don't know what's next. We only have the mean threshold of this candle. That's the last. If we trade past that one, obviously we're gonna wish for this level or maybe the entire range, right? So let's see how the daily time frame price prints. Okay, so right there, this is a trade. You obviously would have had opportunities inside of this candle, but you would use internal range liquidity. You understand that we are coming from an order block, and then during London, obviously this will happen probably during London or maybe Asian session, but London, and then with your 8:30 in my country is 2:30, you would want to see a protection to take internal range to push higher. That's what happened. Now price is at the 50. It's now in premium. So we would anticipate a reaction to trade down, right? So let's see how the day ends. You have a reaction from the premium price past the order block, this one, the order block body, 50%. So now if you took a sell on your 1 minute, 5 minute, this could be a sell, a valid sell, but I will show the setups on the next video. And then that's how the day ends. So you have a push up, a push down, giving you a second opportunity to buy on your lower time frame if you are bullish to buy. So if you are in premium, that's your opportunity to sell. Right here, we are in discount on an order block, you would want to buy there. That's how you should frame your directional bias. So right now, if I would see a pattern to sell from here, I wouldn't be confident because I'm still in discount. As much as this is a fair value gap, if I don't see price reversing or giving me a swing, I wouldn't be comfortable selling this. If you want to be safe, you would want to see the next candle reprice it lower to form a swing, and then you trade the fourth candle to continue down. That's the safest way of approaching it. So like per se, you see this, you have a candle, a lower low, and then you have a high. Okay, this is the highest high, the highest candle. So you have this, a low on the left, a low on the right. You would want to trade the next candle to continue down, take out this candle. But you see, this is a Sunday candle. We have a whipsaw, but obviously there would have been a trade on this day to trade down, targeting this. So yes guys, if you want to see how I would have entered on the lower time frame, the 5 minutes, 1 minute setups that we've learned from the 2022 ICT mentorship, you can leave your comment down below. Or if you have questions about this video, you can be welcome to leave a comment down below, and I'll try to break it down even further. If you're still confused, you're also welcome to leave a comment down below. I'll try to do my best to explain or polish some things up. But otherwise guys, please like the video and share if you can. It would help with the YouTube algorithm. And thanks. See you in the next video.